All right. Okay. Yeah. Welcome to our live session on how to boost shareholder value. In today's session, we are going to discuss buy and build strategies and how such a strategy can contribute to your shareholder value. I will discuss this with my guests, Rob Verbeek from Arcus IT, Michael Ambros from Ecomi, and Lars van der Dunendal from Bright Capital Partners. And just first some words to the audience. If you feel like you want to raise a question, please put that in the comment section, and we will also discuss this here. Yeah. Generally, let's go to buy and build. Generally, in a buy and build strategy, a target company or target companies are acquired in a fragmented niche market with the goal or with the plan to create value through consolidation and synergies. And for that, I have my guests here. And just the first quick round of introduction. Rob, to my left, is the CEO and founder of Arcus IT. He founded Arcus in 2016 with the goal to become the leader or a leader in the IT workspace management. And Arcus currently has more than 1,000 customers across multiple segments.
Correct.
But you've done already another, or you founded already another company before. You've sold it, so you have a longer history. Tell us a bit about your history and how many acquisitions you did already in the past.
Okay. Yeah. Well, I'm not a born entrepreneur. I've had a normal sales IT career before I started my first company. I started my first company in 2003, 2004. Let's say just after the first internet bubble burst. And that was a company called Ayaso, and we made online backup software. And the interesting thing about that is that Ayaso, although it is already sold almost 10 years ago, still plays a central role in what I'm doing right now.
Mhm.
Because I'm currently basically buying up all the customers that we had 10 years ago. So what we did with Ayaso was we introduced a new concept in the Dutch market, and that was the online backup managed service, and basically we laid the foundation for what became the MSP market by helping the IT resellers, the traditional IT resellers, with their hardware reseller and break fix models,
Mhm.
where they charge their hours, etc., and do the work. And we help them to become managed service providers, basically, because online backup was, well, at that time, the first service that made sense to sell to the mid market. So we enabled a lot of Dutch IT companies to become a managed service provider, and that was at the end also the basis for the success of Ayaso. We built it out. We were fortunate that at some point we got a couple of larger customers like KPN, who helped us to really accelerate growth. We survived the crisis, also a little bit with the help of Lars and his friends. By that time at Main Capital, we needed money to survive the crisis when we did. And well, at the end of the day, we sold the company to GFI, which at that time also was a powerhouse in the ICT reseller market. And by now, Ayaso is part of what's called SolarWinds, and SolarWinds is still a powerhouse in the IT reseller and managed service space.
Mhm.
Well, in between Ayaso and Arcus, I've had a brief stint at a web hosting company, basically. And what I did there was increase sales also by introducing a concept for the ICT reseller market. But that company was sold pretty quickly, and then I had to start thinking, what is my challenge for the coming years? And what I saw in the hosting sector was a consolidation, and I expected that the consolidation would also happen in the managed service space, which I knew very well from my Ayaso days. So that's when I decided around 2015 that I wanted to be a first mover in the consolidation phase that I was expecting that would happen in the managed service space. Now, I was correct. And if you look at 2016 versus now, there's so many more people doing what we are doing. But we were an early mover in 2016. We started with one small acquisition, 18 people. That was the starting point. We did one smaller acquisition in the same year, 25, 30 people we were in total. Then in 17, we first doubled with one acquisition. So we became a company of 9.5 million euros revenue and 55 people.
Mhm.
Our first remote office. We are located in Zwolle in the eastern part of the country. We got an office in Rotterdam, completely other side of the country, which already was a management challenge. Well, then we were becoming a little bit more well, let's say daring,
Yeah.
we had a little bit more confidence. So the next year we did two acquisitions at the same time, and we doubled again. So we went from 50, 55 people to 100, 110. Well, after that, the ball started rolling, and by now we have done 10 acquisitions. We are 180 people strong, 30 million plus revenues, and well, we have an ambition to grow in the next couple of years to 500 people, 100 million revenue. That is our goal.
Yeah. So really a leader in IT workspace management.
Yeah, yeah, I'm proud to say, but I don't realize that every day. But people say to me, "You have to celebrate your success every now and then," and I tend to forget that. But yeah, we have made a great accomplishment, and it is really thanks to the team, thanks to the people on the work floor, and also thanks to the customers for their patience that they have with us, but because we also make many mistakes. But maybe we're going to talk about that later.
Yeah. Wow, interesting. Very interesting. To the left, Rob, we have Michael. Michael is CEO and founder of Ecomi, and he founded Ecomi in 2008. And Ecomi provides a SaaS suite for customer, product, employee feedback / experience management. And Michael is following a buy and build strategy already for quite a while. And in recent 8 months, it got a little bit more intense. So you've done 2 acquisitions in the recent 8 months. What was the starting point? Tell us a little bit about your story.
Yeah, thanks, first of all. So when we started Ecomi, then the review space was quite fragmented, or it wasn't really clear that there will be a review company at one point. But then at one point, Google became very, very dominant on increasing the quality by those 5 stars all around the place. That is now in Google Maps, that has become in Google Ads, but also in organic search. And so from that moment, it has become obvious for us that at any time in the future, and the future has begun already for us, that businesses will compete around more and better reviews.
Mm-hmm.
And like we figured out that one of the key differentiators is that you need real reviews, because you could put any testimonials or review on your website, but if the reviews are third-party validated, then obviously that increases the trust. And if you have more trust, you make more sales. So now a little bit into the company development. At one point, there was the decision, or there was the idea to either sell the company or to either expand in that space. And I would say, at one point I had the right partners around me to really have a sustainable buy and build strategy, because obviously we started a business from scratch.
Mm-hmm.
And once basically, I had the right partners, including Pride and the team and everything. So we could really make a real business around executing on a buy and build strategy. So now basically we have looked into, that's why the deal Klantenvertellen is one business we acquired here in Holland. So we have now a very nice office in Tilburg. So that was a very interesting setup.
Mm-hmm.
Klantenvertellen is the market leader in Holland. So it fits very well together with Ecomi. It's pretty much exactly the same business. And as well, we go into other areas regarding our buy and build strategy, mostly when we can collect reviews. So we also added a hotspot company to the mix, and the reason why hotspots is interesting for us is because for many businesses it's the only way to actually collect reviews, because the most difficult part in a review business is to collect reviews. So and for that reason, so yeah, it's an exciting setup.
Yeah, interesting. So it's also broadening the product spectrum, not just
Exactly.
broadening the geographic reach.
Yes.
Yeah. Last in our round is Lars. Lars is managing partner and founder of Pride Capital Partners, and he has more than 30 years of background as an investor slash financier in the tech space. And you supported Rob and Michael in their buy and build strategies. How exactly did you do that? Tell us a little bit about it.
Yeah, well, to start, I know Rob from the IASO days. You just told us about, and in the type of business we're doing is providing finance. In fact, we provide you with a stick to make a bigger jump, to be able to either grow faster or accelerate through making acquisitions. And especially the last one is not easy, but it's if you can do that successfully, you're not paying too much. You can integrate companies successfully. You can really create a lot of value, and because you have in the meantime more people working for you. Most of the time they're talented and skilled people, so you have a bigger footprint, and then it's an easier way to grow the business than, for example, autonomous growth. So Rob, I know from the YASO days, and I think we chased him for 2 or 3 years, Rob, and then
Sort of, yes.
sort of.
It felt like that, yes.
Yeah, he's a hard nut to crack. But yes, we were able to work together. And the nice thing about the Arcus proposition for us was that there was already 4 or 5 concrete opportunities in the pipeline. And so it was much more about execution than about finding, negotiating, etc. So it was more about, okay, let's sign the deal. Let's
We were ready to
do
go.
it.
Yes.
Absolutely, which was very fine with us. And with Michael, we first had to do the buyout. He's a Berlin-based company. He had big shareholders before we came on board. Michael, you had like Goldman,
Exactly.
so not a small one. So we knew we had to walk on our toes to be able to make a difference.
Can you do that now?
Sorry,
walking on your toes?
I sometimes, yeah. But then I was 2 years younger, of course. No, but and yes, this opportunity in the Netherlands came up, Klanten vertellen. But in the meantime, and of course, for us, a Dutch deal, working on a Dutch deal is of course simpler because we know the language, we know the system, the legal system, and we have a name, brand name in here, so it's able to really make a difference in deal making. But you now have a slate of, I think, 4 or 5 very concrete opportunities, varying from the Netherlands to France, Germany. And this morning, I had a call with one of the candidates. He was based in New Zealand. And he had an advisor from LA. So we were in 3 different continents, 3 different, totally different time zones. I was drinking coffee this morning. The LA guy who wanted to go to bed, he was drinking a beer, and the guy from New Zealand, it was the end of his business day, so he was drinking a red wine. And so, but that's the nice thing about growing that way. And if you're able, it's more technically, but if you're able to buy, let's say, smaller companies, and you combine it into a bigger company together, you make some multiple expansion. That's how you create value.
Yeah, very interesting. I think it's time to talk about how you, especially you, Rob, and Michael, came to your buy and build strategy. Rob, you told us already that you tapped your toe, you tapped your entire foot into this water already, but you have different strategies. Can you, first of all, let's start with you, Rob. Can you maybe compare your strategy to Michael or to the general strategy of a or general approach in buy and
Yeah.
build world?
Well, what I can say is we have a dual strategy. Of course, we have our autonomous strategy. What do we want to be for our customers? What do we want to be for our other stakeholders, like our people? And this is also something that we continue to develop. So we really want to become a very good company, both for our customers and our employees. So we always say that the business value is a function of the employee value
Mhm.
and the customer value that we generate. If we don't do that, it doesn't make sense. And the business value, the shareholder value, follows after that. So we have a good and clear strategy that what we want to accomplish, and the buy and build is basically adding to that. It makes sense for us to become a nationwide operator with 8 or 10 offices, because then we can better support our customers.
Mhm.
Because then we can plug into the national labor market for employees. Then we have the size, the critical mass to be a better employer, to give our people development opportunities, etc., etc. So these two strategies are of course enforcing each other, and complementary. But like I said in the beginning, we started this company from the premise that consolidation was going to happen in the MSP market, and consolidation is necessary.
Mhm.
There's an increasing pressure on every aspect of what we do. For instance, security. Well, I don't have to explain to anybody that the IT infrastructure of everybody, including you at home, but every company, every organization, the IT infrastructure is under fire.
Mhm.
And if you're a smaller company, it's much more difficult to well, organize your security, certify your security, etc., etc. So alone from the security point of view, it is already necessary to scale up,
Mhm.
because it's very expensive and very dangerous. It's a dangerous world out there. So that's already an important reason to do this consolidation. Of course, there are scale advantages. There are pressures from for instance, suppliers like Microsoft, who don't want to deal with smaller companies
Mhm.
anymore. They are not good at it. They are not good at dealing with IT companies with 2 or 3 million in revenues. They just don't.
Yep.
So if you want attention from the major players like Microsoft, like HPE or whatever, what have you, you have to be bigger to be able to engage with them. So, well, it's a dual strategy, and it's complementary, and it is necessary.
Yeah. Yeah.
Simple as that.
Yeah. Very interesting. And would you say that you, when you started off this buy and build path, it was basically also the foundation of Arcus IT? So it's like deep down in the DNA, and obviously you have a dual strategy.
Yeah.
But did you learn also something from how, for example, private equity companies did such strategies?
Not really. To be honest, we just jumped in.
Okay.
And if you read our first business plan, it was much more modest than that we are today. So we originally started with the plan. We bought a company with 2.7 million in revenues, and the original plan was to grow that to 10 million. But hey, if you do that with 2 acquisitions or 3 acquisitions in 2 years, and you're already at 10 million, then you start to think again and say, okay, this makes sense what we are doing. And you invent basically how the wheels are moving,
Yeah.
and what the underlying principles are, and of course I have some experience with private equity / venture capital, and well, let's say I have some money in the bank. So if you go to the bank and you say, I don't need your money, but I want to have it anyway, then it's easier to get. And that's how I started. And if you look at me right now, I'm fully invested in Arcus. So
You don't have any money yet.
not a lot, no. It's all in the company.
It's
Yeah,
all spent.
with a small buffer, of course, but well, it makes sense to invest in this company. So
Yeah.
Oh, absolutely.
I've done that myself as well. So, but you learn along the way.
Yeah.
And well, I don't know. We have this principle we call Pippi Langkous. You know Pippi Langstrumpf
Yeah.
probably. And basically she says, I don't know how to do it, but I have never done this before, but I think I can do it. That's
Yeah.
what she says. And this is also what we are saying to each other regularly. We haven't done it before, but if we use our common sense and the experience that we have so far, then we just take the jump. So,
Yeah. Yeah.
and
Interesting.
let's say my risk tolerance is probably also a bit higher than of the average Dutch entrepreneur.
Yeah. Yeah. Pippi Longstocking. That's a nice idol to
Yeah.
follow. Michael, you told me once that that you had to, or that you are particularly proud of a leadership team you established on top of a group level. I think that's a very interesting topic to share with the audience. How do you structure your organization, or what do you need to do with your organization in order to make it fit for 1, 2, 3, 4, whatever acquisitions?
So what we did is we structured the leadership team in a functional setup, because so we have a functional leadership team. So because we figured out if you have positions but not functions, then sooner or later you don't really know where you can scale or not scale anymore.
Mhm.
And also from an accountability perspective, we figured out that it's a lot easier to have a function and to make a function fully accountable for its purpose. So for example, if it's tech ops, then you know exactly who owns the function tech ops, and and then it's clear for all the other leadership members as well, who to go to or who to blame or
Yeah.
who to connect with, or who to and how to solve it in that sense. So, and pretty much any businesses that we are looking at, even if they have a functional design or not, so like, because we are only interested in B2B and in SaaS and so on and so forth. So that means every company, even if they don't have the function, then we put it into one of the functions, so to speak, because that functional leadership team is universally valid for any B2B business.
Mhm.
Okay, so we couldn't now run a marketplace business, or we are not the best probably in an e-commerce shop or something like that. So I wouldn't do that. But when it has to do with B2B software, we need sales and product and development and all those kind of things in a B2B environment, then that is something that we can more easily absorb
Mhm.
than if it would be something different. So that's something we wouldn't do, because then we couldn't leverage the synergies, for example, and it would be very, very complex to integrate. So that's why, what I figured out is very convenient. Is a functional leadership team that owns the full accountability for its specific function.
Yeah. Yeah, that sounds like a very theoretical approach and very, let's say, planned approach. Did you learn that from a book? Can you learn buy and build in general from a book?
No, I wouldn't say buy and build basically, but I learned it from. So I hired at one point the guys called Alex Sisney from the US, and so we brought him in once, and he helped us how to. He wrote as well 2 books on Amazon basically, and he is doing that for B2B companies. It's kind of a applied coaching thing, whatever. We did that before already because we figured out we need to change something in our organization, and it just happened that for the buy and build approach, it's the right design because it's made to scale.
Mhm.
And it's a little bit, in Germany we talk often about positions, but a positions doesn't scale, but a role actually does. So it's better to have a role, and specific people need to step into specific role in that sense. And I would say that's what we applied, or that framework comes from him in that case, how they scale companies in the US in particular.
Mhm.
So, and we applied that for our company. So he came once or twice to Germany. So and then we designed it. It's by design.
Yeah, interesting. All right. Maybe a question then to Lars from a finance perspective, then you, Rob, and Michael can jump in from the entrepreneur's perspective. Buy and build strategy. The question is, does it hurt my my organic growth, or What's your view on it?
Yeah, that's of course how you want to organize your team. If you want to buy a company and use all management resources to integrate the other
Mhm.
company, then yes, it automatically hurts autonomous growth because there's less, energy or
Mhm.
resources available. But if you are able to operate, freely in your current business, and you have people focusing on their own, like what Michael said, a functional approach, you can do, of course, together. And so it's also based on the on a strategy. If you want to acquire other companies and really integrate it takes a lot of energy, but you will see a higher EBITDA performance, because you can cut a lot of costs, you can create synergies,
Mhm.
and that hurts autonomous growth. But in the meantime, you're growing and you increase your value. But there are also multiple examples of in the software or ICT services space where you buy companies and let them operate standalone. So you're not really integrating them. You try to optimize some elements, but not but in fact you want to let them run autonomously.
Mhm.
And that's another strategy. It's also a good strategy. And yeah, in the meantime, everybody can create their own value by grow autonomously. So it depends on the strategy you're choosing.
Yeah. So like a two-pillar strategy, which is also part of your DNA, then that's
but
not hurting the
it,
organic.
I can tell you from experience that in the short run, you have to be prepared to lose some revenue volume,
Mhm.
because every acquisition that you do, you have customers that don't fit. If you buy smaller companies, they normally have a different relationship
Mhm.
with the, let's say, with the owner operator that you basically take out when you acquire the company. And we've seen that the smaller the company we buy, the more customers we lose, because the customers don't fit with. They choose for a smaller company for a reason.
Yep.
And if they have larger customers, most larger customers like it when we buy the company, because they say, well, yeah, this company basically is a bit too small for us, but they do our IT and we trust them. But okay, we are very happy that you buy them, because now we know that we are part of something bigger.
Yep.
And that you can continue to support us in the longer future. But the smaller customers, sometimes you lose. So what I always say is the quality of our revenue increases.
Mhm.
And we always also, of course, score new customers, and that offsets what we lose. And in the years that we don't acquire, we usually grow organically. But in the years that we acquire a lot, we don't grow organically,
Yeah.
or not a lot. Sometimes we even shrink a little bit.
Mm.
But at the same time, the quality is increasing. So who cares?
Yeah. Yeah. Quality is also a good point. Quality can also be measured, like let's say international customers. What happened when you acquired Klantenvertellen? How did the customers react when they were probably suddenly told you will have now a German provider instead of a Dutch provider?
So first of all, we um, uh, so when we acquired the business, we didn't go in and change the name and everything. So we applied an approach where we wanted to integrate the business as seamless as possible, so that the customers almost don't notice anything, and if they notice something, then it's just a value add. So there was there was overall a very positive um, uh, feedback. So we have, I don't know of any really negative thing. A lot of Dutch customers in that case, they also grow internationally. So they have additional value benefits. So I talked with one customer and he wanted to expand to Germany anyway. So, and for that reason, he wanted to look for a more international company. So that existed as well.
Mhm.
So I said, hey, that's perfect. We can get it now everything out of one hand. So in that sense, and the other thing is, like, we did now say, hey, we rebrand the whole setup here in Holland, for example, because you know, So my idea is that you leverage off an existing brand as well. So customers that, for example, the website is found in Google. So you have rankings, you have the marketing, you have the brand and everything. So we didn't have the brand name in Holland. So why should I change something in Holland that I couldn't leverage anymore? So like I believe in 1+1 is 3.
Mhm.
So for that thing, so we don't want to cut the one down. So we want to have the one and rather strengthen it in that sense. And that's generally what I believe. And in the back end, we obviously make the necessary changes to have smoother processes or cost savings or efficiency increase or whatsoever. But most importantly, the customers, they have they have a reason why they went where or the way they made a deal before.
Mhm.
And we just want to make sure we can fuel that so that the customers get more value. And that's it.
Yeah. Yeah. Interesting. So it's a lot about also finding these value-based companies that you can integrate. That
Yes.
was 3. What are your channels? Maybe you can start, Michael, and then you also continue, Rob.
So channels is it starts with once you know what the target companies are. So in my case, at least in the review space, there's not so many companies actually that um, that they are available. Let's put it like that. So that's why you can look into similar areas. That have to do something with reviews, where reviews is maybe not the main theme, but it's an important aspect of it in which we would increase our customer base.
Mhm.
So, but generally speaking, it's either through network or it's through reaching out to somebody and starting with a strategic, most of the cases operative discussion as well, in which we look at and we say, hey, what can we do together? Because typically the companies we talk with, so there's a value between reviews and whatever they are doing. So if there's an operative fit, then obviously there's also a fit once you combine the businesses. So that's it.
Yeah. Well, your channels, Rob? Where do you find your treasure chests?
I just made a quick calculation in the back of my head listening to Michael. I've bought 10 companies, and 4 of them I've approached directly from my network and just called them up and said, basically, is this joint for sale? And the other 6 came through various channels, advisors. Well, you know how it goes, the Brooks and the Deal Suites, and so let's say the open market. But I prefer to use my own network.
Mhm.
And I'm currently talking to a number of companies that I know nobody else is talking to. And well, that will normally deliver the best value, the best deal.
Yeah.
But because at the end of the day, it's people's business. And you talk about entrepreneurs who have spent most of their life building something up, and well, if they sell it, they want to make sure that it goes into the right hands.
Yeah. People's business is a very good point. So it's a lot about culture as well.
Yeah.
And what do you need to see in a first management meeting to assess? Yeah, I have a click. No, I don't have a click. A beer on the table.
No. Well, it starts with the business fit.
Mhm.
Yeah, if the business fit is there in terms of what customers do you serve, what types of services do you provide, how do you do it? Most MSPs with let's say between 20 and 50 people have a similar similar technical culture. Most of those companies start up from a technical start point. Most entrepreneurs in the IT space are technicians who didn't want to work for a boss anymore,
Mhm.
and started for themselves 20, 30 years ago, and learned the ropes of entrepreneurship one way or the other through practice. Well, that's also the reason why all these companies are between 20 and 50 people, and most of them between 20 and 30. because that's a sort of natural limit that you run into at some point.
Mhm.
And then you are happy because you make enough money, and because, well, nobody has to complain if you are a single entrepreneur with 20, 30 people, and let's say 4 or 5 million revenue, and the profit that goes with it, you have a nice life.
Yep.
So it's a little bit of lifestyle entrepreneurship. Well, if you run into those companies, well, they will be happy to see that their company goes into the right hands. But most of them are doing more or less the same as we are already doing
Mhm.
in terms of managed services. They are treating their employees the same way as we try to do, maybe a little bit more professional than they are doing. And what we also always do is we leave them the space to have their local customers, and they continue that. So in one location, they are having whatever French fries on Friday, and on other locations they are eating whatever French toast every afternoon. I don't care if they like to do that. Please continue to do that. And it's also why I involve members of my management team in these first meetings, because I want them to level with the selling party, and make sure that first of all that they are happy with the acquisition as well,
Yeah.
because I'm looking at it more from a financial point of view. I'm not that deep into the MSP business. Yeah, I understand it, but don't ask me to do it myself. So I need my management team also to assess the quality, and if they start to tell our story also to the selling entrepreneur, you quickly see if there's a click or not.
Yeah.
And mostly there is. So
Mhm. Yeah. Interesting. Yeah, Lars, you've seen a lot of companies in the past, in your 30 years of as an investor. Would you say culture is one of the predominant topics to assess a company on, or would you say it's a little overrated?
Culture.
Culture, yeah.
Okay, that's overrated. It's especially in the software or ICT in this market. It's it's young companies run by not too old people. Yeah, we are old, maybe Rob, but
Sorry.
and, Michael not. So that's what you see. So then culture is not a very important topic. It's more about strategy and product, especially in the software. It's about product and beliefs in that, and setting up a recurring model, business model. Yeah, and from our perspective, it's of course deal making, and well, what you said, Rob. It's how do you approach your acquisition targets, and especially you have this nice model because you already had this database of IASO customers you could easily tap into because you already know them, they know you, and then if you're buying a company at the end of a personal life cycle of an entrepreneur, then of course he's looking for a good price, but he's also looking for a good future for his employees. And that's another way of deal making than in for example in the software where there is all these young guys and competing with private equity who can pay sometimes huge amounts of money. So that then and then it's that's a different story. So you have to be compelling in another way.
Mm.
What I would like to add though is what we do deliberately do is we have chosen for a model where we say we do not want to grow our subsidiaries too big.
Mhm.
We want to stay close to the mid-market feeling. We want to become a 500 employee company, but we want to do that not from a central office somewhere in Utrecht or whatever with 500 people in one office, but we say our subsidiaries should not be bigger than 40, 50 people. And that is an element of culture that we want to preserve because we want to stay close to the world of our customers,
Mhm.
who are mid-market customers, and also close to the world of our employees who have normally deliberately chosen to work for a somewhat smaller company. So if you make the subsidiaries not too big, we believe that we can keep this mid-market feeling alive, and I think that that's an important cultural element that we want to preserve.
Yeah, yeah, interesting. We just heard from Lars that this morning a New Zealand-based company and a US-based advisor and a Dutch not entrepreneur investor were in a call, and it was about economy and a potential target. So it's a concrete process. That's not where I want to go, but where I want to go is an LOI is probably now on the table. What elements do you think are very crucial in an LOI? What do you put in an LOI?
So from my perspective, I'm very detail oriented on the operative side. So that means basically, if I I need to see beforehand that after the integration, or at least the strategy thereafter, is easy to be executed.
Mhm.
And I want to make sure that everybody is aligned from basically before even we sign an LOI. So that means there's those elements, basically how do we operate thereafter. So again, you cannot lay out everything right there, but there's a baseline parameters of who's the key employees. So what is happening thereafter, what are the goals thereafter. um, and so that's part of the LOI. Obviously the price, and obviously a couple of other setups to understand if the pursuit of the deal and the investment, because it disrupts the organization as well, and so on, and you can do other things.
Mhm.
So to make sure you're aligned on that, and then you have a base for doing the next step.
Yeah, and then the next step is obviously the big closing mode that everybody is looking for. You turn it on, the switch is on, closing mode is now on. You are in due diligence. What are you looking for? Is there anything specific you are in the first moment looking for?
Yeah, in particular, it's always two sides. It's obviously on the one side always a cost saving component. So that means, is there something that in a group we can do better, different, or better? Or on the other side, is there a value that we can pick up quickly that maybe somebody hasn't seen, or that based on a new approach we can upsell very, very easily. So, and that's the two sides that we're looking at. So cost side and obviously quick value increase by an upgrade, so to speak.
Yeah. And Rob, what about you? Do you have any specific targets specific KPIs you're looking for, operational, financial KPIs? These needs to be investigated in the due diligence.
Yeah, well, you always look for an upside.
Mhm.
We are of course buying companies for their current run rate, and we always it's always an interesting trade-off between buying a very profitable company that is doing everything right already, and then pay a high price, or find those gems that are a little bit rough, and where you can will probably have to put in some work to make things right. But if you do that, it gives a big value increase. Well, so I have a benchmark of what I think is how a company like an MSP should look like in terms of the P&L. So how much personnel cost compared to revenue, how much gross margin, average cost per employee, things like that. So I like to benchmark the companies that we are considering, and if they are doing better than the benchmark, then I'm probably less interested than if they are doing worse than the benchmark, because then I can improve something. And
Yep.
But if they are doing better than the benchmark, I'm always looking, of course, for what do they better than we are doing, because well, basically we are the benchmark. So we are looking at what are they doing better than we are, and can we learn from that? So if we would acquire them and pay a high price, does what they do, can we apply that to the rest of the company, increase the value of the rest of the company? But so far, I haven't found gems like that.
Yeah.
So mostly we try to buy, let's say, a little bit underperforming and undervalued companies and make them better.
Yeah. And would you say that's because of their life cycle? Because they are much more, let's say, ripe than Arcus, and those ones not. So you can either you are, let's say, in your thought process already three, and that's what you can skip for these companies.
Yeah, well, not every entrepreneur is always very cost conscious, and sometimes they just have too much overhead, for instance, or they are not smart in buying stuff. So it's really a big mix of reasons why sometimes these companies are performing worse than we are. The first big acquisition that we did in terms of the first doubling that we did, like I told you in 2017, that company was losing well, as much money as we were making. So they were making a loss as high as our profit was on the same revenue. And what did they do wrong? Well, it was not too difficult to set that straight. They had a couple of directors that were overpriced and not performing. They were underperforming on the technical side, where customers were not very happy. And they were outsourcing stuff like their cloud platform that we have in-house. And we have much more control over quality, but also making a lot of money on it. There's a good margin in having your own platform. If you do it up to scale, if you have sufficient scale, you can make money on it. So they were basically there were some very big quick wins that we could make. So it took us a year to set it straight. But after that, it basically also doubled our profit, and we didn't pay a very high price for that company. I can tell you. If it was an EBITDA multiple, they should have given me money, but they didn't. But at the end of the day, it was a very good deal, and it laid the foundation for what we are today. So.
Yeah, interesting. So let's be very practical. Now we are 1.5 years in the Corona time. You have done acquisitions in this period. You have done acquisitions in this period. How do you do that? You cannot meet. We all are maintaining the distance. We all tested. But how do you do it in this Corona times?
Well, you tell me.
Yeah, very simple. So, I mean, if you hide, then basically, I mean, you can't do anything. So I think I decided to double down actually. So because it's a choice, you can either hide in a basement, or you like travel and basically attack where nobody is basically out there. So that's what I would say. Plus the other thing is right now, in average, more people, if at all, than they think right now. At least some companies are not for sale. But right now, when people get used at home, whatever, I've seen that, then at least they get used to it in one way or the other. And then at least, you have a conversation in that sense, whereas before you wouldn't even have the meeting. So I would say right now it's a good time if you're willing to do the work and if the team is basically, on it. So then it's the right time to do it.
Yeah.
So, but again, if you're hiding in a home office or if you're hiding somewhere, then it's not working. You shouldn't start at all.
Well, actually, I did one closing from a beach hotel, but yeah, that was last year when the beaches started to open up again, and we had a closing, and we just did it online. But I must say I had a great pipeline at the beginning of last year, so before Corona hit us. And the 4 acquisitions, 3 out of the 4 acquisitions that we did last year were already in the pipeline, and you already have this relationship going on.
Yep.
And then it's not too difficult to finish it off digitally. And the last one, well, we basically developed a relationship, and for a part online, and for another part, we just went out. And I'm still going out. instead of going to the office of the target or coming to my office, we rent a space in a hotel which is a little bit larger so that you can keep this social distancing going. So and yeah, it is improvising, but it's still possible.
Yeah.
So and you have to go out indeed, and I don't like to hide in the basement. It's crazy.
Yeah.
Yeah. Well, what did we do, Lars? We made this deal also in the middle of Corona. Yeah, we just said, "Hey, how are you doing?" And we gave each other an elbow rather than a hand.
Yeah, absolutely. You
Yeah.
know, so it works. Of course, it's not ideal. You like
No.
to look and to see each other, face to face, because that's how we are trained. But probably, the generation who are starting the jobs right now and work much more from home or remotely, they maybe don't need in the future this physical meetings to know what's happening. But indeed, we had to be flexible to do it, and it sounds like you have to take a bigger risk, but I don't think that's the case.
Sometimes we bend the rules a little bit. If you raise a glass of champagne.
Yeah, absolutely. But also for this meeting, we are all tested. We have to apply to certain rules. That's what we're doing. But once you've done it, you can the world is still out there.
Yeah.
Absolutely.
All right. Very interesting. So we went through closing mode. It's all signed, sealed, and dusted. Let's say. Now the real work begins. Although we don't have a lot of time left, but real work is now post-merger integration. Let's look at the customers. We once touched on this. Customers might walk away. The quality in general improves. What do you do in particular to inform customers? Do you do it in one big campaign, or is there any secret to approach your customers and inform them?
Well, for me, we have a clear goal to rebrand and make it one big company. And we take our time. So it takes three to 6 months to do it. But we also see that our employees usually want it. They want to feel part of the family. Well, so we are just we have a plan and a schedule and a checklist, and we just go for it, and we don't spend too much time on transitioning because, well, basically the companies that we buy, the brands are usually not very important to us, etc. So for us it's easy, but I understand that you do it differently, and if you buy klanten vertellen in Holland, then it's probably better to keep it like that. But for us, it makes sense to rebrand and move quickly.
Yeah, so the rebranding is not part of that checklist. Let's put it like that. But it's more like the internal processes and internal functional things that we may put together, be it like, for example, finances or something like that. And on the other side, it's creating an upgrade path or upgrade story to a leverage of that side as well. So as I said before, but yeah, in this case, the checklist is not to unify everything. So we also we want that an independent management is still in place, if that's a strategy from day one, because otherwise somebody else need to take care of it. What is additional risk? So, and if that risk is calculated, then it's fine. But at the end of the day, it's about growing together in that sense. And so, because we have a very entrepreneurial structure, not a corporate structure, I would say. So that's why I think I'm very I think it's a very promising approach. So to build with more people something together.
Yeah. And do you also, let's be concrete with the two examples. Did you also decide somebody of management's of the target's management is really like capable? I love him. I want to take him on.
Yeah, so that's always clear from basically before it starts, so to speak, and then it's maybe verified in your due diligence. So at the end of the day, so whatever companies it is, I think you need to look at all strengths that there are. Like I believe you can change somebody or something, so it's too much energy, but you look where can you rather put fire behind,
Mhm.
and with fire behind, I mean energy. So and if there's one specific case, something very good. So why would you change them to your own style if you just need to, put a little bit more fuel on it,
Mhm.
and then actually you can benefit and take advantage from it. So I think that's the way to look at it.
Yeah. So it's about transferring the vision,
Yeah.
and how do you do that? For example, Rob, with your multiple acquisitions, it's like
Yeah.
being a preacher every single time.
Yeah, well, for most of the companies that we acquired, for the employees, the acquisition is a surprise.
Mhm.
They are not part of it, and usually the selling owner only tells it to his employees after the fact, after the deal has been signed. So we and then in one go, most of the time they say, and we are going to leave. So the sellers usually leave after a while. They either retire or are going to focus on another part of the business that they already were developing along the side or something like that. Um, so for many of our employees, there's sort of a black hole that they fall into after the acquisition. Well, I'm very fortunate that I have a team of functional directors, three of them at the moment. So a finance director, an operations director, and a sales director, and they are picking up the pieces very quickly. And they are so experienced in taking these people under their wings and making them feel comfortable again.
Mhm.
That's usually after the first shock is gone away. We quickly establish relationships with the people. We quickly find out what the quality is. This is something that is very difficult to assess during due diligence because we usually, with the smaller companies, don't get access to personnel. They want to keep it a secret. The sellers are very afraid of having either their customers or their employees getting the wind of that they are selling the company. Yes, because they are afraid if it fails, then it backfires. So it is difficult to assess the quality of the people usually before we buy something. But well, by now we have let's say some experience with what we expect to find after the acquisition. And sometimes you're lucky and you find somebody who has a talent and that you can further develop and become part of the larger management team. And sometimes it's just bad luck, and then you have to do your thing. But that's where we have an HR department for.
HR.
Yeah, yeah. It's unavoidable.
By the way, it's
Yeah.
almost time, but maybe good to, because also
Yeah.
Germans are looking. Rob, you want to acquire a company in Bremen. You're looking for Munich.
Yeah, well, if there's somebody out there, yeah, we have. Interestingly, we have a number of customers in our current vertical sectors, particularly in the healthcare space, that are doing their own buy and build. We have a dentist chain who is also active in Germany right now, and they asked us to support them in Bremen and in Munich. And we have a new startup or scale-up company that is going to acquire GPA practices. Then we have an eye clinic chain that is coming from Germany, I think, iScan. There's also doing a buy and build, and so there's a number of our customers, larger customers, that have asked us to support them in Germany. So it does make sense for us to spread our wings to the German market. Yeah,
Okay.
but I don't speak German. That's a bit of a challenge.
No, but the Germans don't speak Dutch either. So.
No.
We try.
Yeah,
Okay.
ambition. Huh?
Ambition.
Ambition. Yeah.
All
Yeah.
right. Hey, but Philip, well, thank you for organizing this.
For keeping us
Very good.
talking.
Yeah.
Thank you.
Very good. So, yeah.
Yeah, I hope you enjoyed it. I hope everybody was satisfied and you learned again something from this. And I think we will see each other soon. Hopefully then physically again.
Thank
Okay.
you.
Yeah, that would be nice.
Thank
Thank
you.
you.
Yes.
And thank you guys.
Yeah,
Thank you.
and thank you guys.